All right, welcome to the Module 2 Tech Workshop. Here we're going to take a look at buying and selling options and kind of what this looks like in the platform and what are the kind of important pieces to know. So it's partly foundational, partly tech, this one, but let's dive right in. So first thing we want to know is why do options have the values that they do? Why can you buy or sell an option for a certain price? And it's really a function of a few different items, but first of all, the underlying price. So let's take a look at some option prices. Let's take a look at, say, Apple, and we'll go to the April expiration, so 61 days, and let's take a look at the closest put to the money. So it's a 47 put. So we've got in Apple the 47 delta put is selling for 320. Sell the bid, buy at the ask. So $3.20, and it's 135 strike price. Okay, let's then look at Twitter, TWTR. Okay, and same expiration, 61 days. And let's take a look here at the puts. So the TWTR, the 47, we don't have a 47 delta, we have a 37 delta and a 52 delta. So let's go with the 52, and that is going for $1.23. So you can see the options are fairly close in delta, but they have a significant difference in price. There's a couple of reasons for that. Let's go with something just a little bit higher in price. Twitter's just a little bit low. Now I look at it. Here we go. So GameStop. We got a 43 delta in GameStop. So let's take a look at that one instead. So I'm just going to erase Twitter. So there's a reason, another reason why the Twitter one was a little bit more, and we'll talk about it in a later module. GME, the 43 delta is selling for $1.31, and it's the 25 strike. So first thing is higher priced underlying, higher priced options. It kind of makes sense. You know, the price of the option is derived from the price of the underlying, so it's going to be high. The next one is the strike price. So as we look at the strikes here, as the strikes change, the options change in value, and it's essentially the inverse of each other. So on the put side, as the strike prices go up in value, the puts get more expensive, and on the call side, as the strike prices go down in value, the calls get more expensive. And that's because if you think about in module 2, our bulls versus bears, the puts are bullish strategies, so they're going to make money when the puts, when you sell the puts, are bullish strategies, so they're gonna make more money, gonna become more expensive if you're selling them as the stock goes higher, and then the reverse for the calls. But we'll dig into that here a little bit more detail in a second. And then the next piece is intrinsic versus extrinsic value. Okay, so what does that mean? So here we're into like definitions. All right, so extrinsic value is a function of time and volatility. So if we think way back to module 1, our analogy when it came to selling a put, and it's true of selling a call too, it's just calls the opposite of a put in terms of price movement. We talked about the value of a put or value of an option increases as the amount of time, the length of the contract increases, and the volatility increases. Let me clear off the screen here, and let me take a look at some of the strikes. So the 25 strike in GameStop. So with 61 days to go, right here, 61 days, the 25 strike, which is approximately 43 delta, is $1.31. Okay. And then let's go out in time. So if we close out April, and let's say I open October. I don't make quotes for October, a little too far. There we go. So we'll look at July. So it's 152 days. So we got 152 days. We've got the 25 is a 44 delta, and it is $2.24. So the same put at the same strike with almost the exact same delta costs more in the later expiration than in the earlier expiration. Okay, now that should make perfect sense because you're paying for time. The more time it takes for the option to expire, the more you're going to pay. That is part of extrinsic value. The other, and this is sometimes harder to show in practice because it depends on prices, is the implied volatility. So in my watch list here over on the left, I have the implied volatility of stocks. So what I'm looking for is two stocks that are around the same price with different implied volatilities. So if we look here, TBT is right around $40 and GDXJ is right around $40. But the implied volatility of TBT is 25%. The implied volatility of GDXJ is 46%. So let's compare those. So TBT, and let's look at 61 days here. And do we have any pricing? No pricing in the 61 days, just because the market's closed right now. I'm not getting pricing in those monthlies. That's fine. All right, let's see. This may or may not work out because the market's closed, but we'll see what we get. So with TBT, it has an implied volatility of 25. Let's just call it 25. IV of 25. The 46 delta option is selling for $1.16, and that is the 39.5 strike. That's on the put side. And then let's take a look at GDXJ. So GDXJ is, let's see, GDXJ. Its implied volatility is about, let's just call it 45%. We have a 46 delta? We do. 46 delta. Put is selling for 228. 228. And that is the 41. The 41 strike. So now I know they're not exactly the same, but they're close. Okay, close in price, but quite a bit different implied volatility. You see the difference in prices. Now that's a function of extrinsic value. Okay, extrinsic value is really time value. It's built out of how long is left in the option and how what the implied volatility of the option is. Now you will find, and we'll talk about this a little bit as we go on, extrinsic value is also adjusted based upon how close to the money in a stock you are. So when I say close to the money, I'm talking about the at the money strikes, whether it be call or put, tend to have more extrinsic value. So if I come into Thinkorswim here, let's change one of our columns. Doesn't really matter. I'm going to change probability of IT. I'm going to change to extrinsic value. Take a look at the extrinsic value of the options as they get closer to the money. The extrinsic value increases. So let me bring up some calls here as well so we can see those. So extrinsic value in the calls increasing as you get close to the money. Okay, keep that in mind as we move along. Then the other thing is intrinsic value. Now, intrinsic value only applies to in the money options, and it's essentially a function of how far the option is in the money. So if we think about selling a put, we talked about selling a put. Remember, you sell by selling at the bid. We said that if you sell, let's say we sell the 41 put and the stock goes below 41, let's say it goes down to 40, then this contract gives the buyer of the contract the right to sell you stock at the strike price of the contract. So if you think about it, if the stock is down at 40 and the buyer exercises their right, they will sell you 100 shares of the stock at 41, even though it's selling in the market for 40. So what that means is that the buyer is able to gain $1 on that trade. They're selling it for $1 more than it's worth, and that is the intrinsic value of an option. The intrinsic value of an option is essentially the value of the option to the buyer of the contract. So if we erase that out, again, you don't have to necessarily work out a lot of these things because you can just bring up the information in Thinkorswim. So if I go to Option Theoreticals and Greeks and go to intrinsic, here, first thing to notice, out of the money options, OTM, so that's the options on the call side is above the strike price, on the put side is below the strike price. They all have 0 intrinsic value. You only have intrinsic value if you're in the money, when it becomes worth something to the buyer. Okay? The second you go into the money, you get some intrinsic value. See, that makes perfect sense, yeah? So let's see, the stock is selling right here. The last price it sold for was $42.21. This $41.50 strike has 25 cents of intrinsic value. Makes sense, right? Because if I owned that contract, I would be able to sell these shares for 25 cents more than what they're worth. That's the intrinsic value. The reverse is true on the call side. On the call side, if we look, if you imagine the reverse thing being true, if I were to own some stock, let's say I own 100 shares of GDXJ, as the price goes down, I'm able to buy those shares. If I own this call, I'm able to buy those shares for less than what they're worth. So if I own, say, this 40 call, if I'm an owner of the call, I can buy shares at 40, even though the market is at 41.25 right now. So that's the intrinsic value to the owner of the call. So owner of calls make money when the stock price goes up. Owner of puts make money when the stock price goes down. It's the exact reverse of selling. Now let's look, before we finish up here, at the P&L diagrams for those things. So let's say I'm going to go to my Analyze tab in Thinkorswim. We'll stick with GDXJ for now. Go to my Analyze tab, go to Add Simulated Trades, and I'm going to buy the, so remember you buy on the ask, I'm going to buy this 41.50 call. So let's buy that. Just click on the buy and then come to Risk Profile. Let's take a look at it. So how is this working? So if I buy the call, buying a call is bullish, and you can see that from the chart. It makes money as the stock goes up. And one of the first things you may or may not notice is it's kind of the reverse of selling a call. If you look, there is no limit to the amount of money you can make. So you can make an infinite, I can't draw the infinity symbol. How do you do it? There we go. You can make an infinite amount of money when you buy a call. The amount of money that you lose is capped, and it's capped at the amount you buy the call for. See, it's $2.40 I'm buying it for. So the most I can lose is $240. Now, how do I make money? Well, I make money by the stock going above a certain price, and that's my break-even point. You can see it right here. The stock has to go above 44 for me to make any money at all. So the stock is currently at trading, it'll be trading right here. It's currently trading at 41.25. So in order to make money on this call, the stock has to go up to $44. Now the question is, what's the probability of that happening? And we can tell that by the delta of that call. So I bought this call. It's a 50 delta call. It's about a 50-50 shot of making money. Okay, but it can make an infinite amount of money. Now the question is, I'm buying this 41.50 strike call, why do I not make money when I gain intrinsic value? So if you think about it, we've got, let's change these columns here. We've got, let's do net change. Let's do intrinsic value. So this call right here currently has no intrinsic value, but the second that the price of the stock goes above 41.50, it gains intrinsic value, right? Because I'd be able to buy shares for 41.50. So if the stock price went up to, say, 42.50, I'd be able to buy shares at 41.50, $1 less. So it represents 100 shares, right? So why do I not make $100? When I look at my risk profile, when the stock gets to 42.50, if you look here, the purple line is before expiration. So at the time that it's at 42.50, I'm actually making money. I'm making about $75. But by expiration, I'm losing money. I'm losing about $125. So even though the stock goes up, I still lose money. Now, if I close my position out here at the time, then I'm fine. I make a little bit of money. But if I wait till expiration, I lose money. The reason for that is I'm paying money for this option. I'm paying $240. So although when it moves up, I gain some intrinsic value, let's say I gain $75, that's going to be just deducted from that. So I'm going to lose money overall because I've paid for it. So it's kind of like, you know, you buy an insurance policy, the value of your car goes up. So it's like, well, I've made more money. Because you paid for that policy, you don't make money. So let's look at the flip side of this. What's the other bullish strategy we've learned? We've learned the selling of a put. So this bullish, buying a call, let's instead buy, we bought the 51 delta call. Let's sell, we'll do right of the money. We'll sell the 50 delta put. So I just went to add simulated trade. I selected the bid for that put, and let's go to the risk profile. Look at the difference here. Now, here I will make money, of course, when the stock goes up. But I also make money if the stock goes all the way down to my break even, which is 39. Okay. I start to, the value starts to go down, but I still make money in this area right here. And then when I get to 41, it's about 41.25. I mean, it's 41, essentially the strike price. I start to cap how much money I can make. But my loss side is unlimited. It's literally the reverse. It's the same type of trade, but reverse kind of setup. And the question is, why would you do this? Well, because your probability of making money is more. The stock doesn't have to move for you to make money. When you buy a call, it's true you have an unlimited upside, but the stock has to move in a direction for you to make money. For the put, it does not. So the chance of you making money is much higher, but you cannot make as much money if you're right. The problem is that this entire course is based on the idea that nobody knows what direction anything is going to go. So that's buying versus selling. When you buy an option, the stock has to move in the direction that you want it to. So if you buy a put, it has to move down. If you buy a call, it has to move up. The reverse, selling a put or selling a call, it will make money if the stock moves in your direction, but it will also make money if it doesn't do anything or if it goes against you a little bit. And that's why selling options is a better strategy than buying options. Okay, so play around with those intrinsic versus extrinsic. Keep selling some puts and calls and enjoy.